Hello everyone, our presentation for Accounting and Finance focuses on a 5-year financial ratio turn analysis from 2021 to 2025. Recently, the Malaysian business environment has faced significant challenges, including the impact of COVID-19, inflation, supply chain disruptions, and rising interest rates. To evaluate how companies have adapted to these conditions, we are comparing two major players in Malaysia's consumer electronics industry, Panasonic Holdings Berhad and Panasonic Manufacturing Malaysia Berhad. Using their consolidated financial statements, we will analyze their liquidity, solvency, efficiency, and profitability to determine which company is financially stronger and evaluate their future prospects. Let's look at the data.
My name is Nur Fatin Ashikan and I will discuss the current ratio analysis. The current ratio measures a company's ability to pay its short-term liabilities using its current assets. For Panasonic Holdings Berhad, the current ratio was 1.38 in 2021, increased to 1.42 in 2022, rose to 1.47 in 2023, and further improved to 1.52 in 2024. However, it declined to 1.28 in 2025. Although there was a drop in 2025, the ratio remained above 1, indicating that Panasonic was still able to meet its short-term obligation. For Panasonic Manufacturing Malaysia, the current ratio was 4.38 in 2021, slightly decreased to 4.21 in 2022, increased significantly to 5.18 in 2023, remained stable at 5.15 in 2024, and increased again to 5.32 in 2025. This shows that Panasonic maintained a very strong liquidity position throughout the 5-year period. Next, I will discuss the quick ratio analysis. The quick ratio measures a company's ability to pay short-term liabilities using its most liquid assets, excluding inventory. For Panasonic Holdings Berhad, the quick ratio was 0.79 in 2021, decreased to 0.74 in 2022, increased slightly to 0.75 in 2023, improved to 0.94 in 2024, and declined to 0.71 in 2025. Since the ratio remained below 1, throughout the period, Panasonic may rely on inventory to meet its short-term obligation. For Panasonic Manufacturing Malaysia, the quick ratio was 3.95 in 2021, decreased to 3.62 in 2022, increased to 4.63 in 2023, rose to 4.75 in 2024, and reached 4.92 in 2025. This indicates a strong ability to meet short-term liabilities without depending on inventory. Overall, Panasonic maintained a much stronger liquidity position than Panasonic throughout the 5-year period.
Next is the inventory turnover ratio (ITR). The inventory turnover ratio measures how efficiently a company sells and replaces its inventory. Generally, a higher ratio indicates better inventory management because products are sold more quickly. Based on the graph, Panasonic consistently recorded a much higher inventory turnover ratio than Panasonic throughout the 5-year period. Panasonic's ratio increased from 11.38 times in 2021 to 15.28 times in 2025, reflecting strong and improving inventory management efficiency. In comparison, Panasonic ratio remained relatively low and fluctuated between 2.74 and 4.43 times. This suggests that inventory moved at a slower rate compared to Panasonic. Therefore, Panasonic demonstrated better inventory utilization and stronger operational efficiency during the period under review. Moving on is the accounts receivable turnover. Accounts receivable turnover measures how efficiently a company collects payments from its customer. A higher turnover generally indicates faster collection and stronger credit management. From the graph, Panasonic consistently achieved higher turnover than Panasonic throughout the 5-year period. Panasonic maintained turnover above 9 times, peaking at 12.66 times in 2023. This indicates that the company was highly effective in collecting receivables and converting credit sales into cash. On the other hand, Panasonic recorded lower turnover and experienced a gradual decline from 6.2 times in 2021 to 5.35 times in 2025. This suggests that receivables were collected at a slower rate compared to Panasonic. Overall, Panasonic demonstrated stronger receivables management, more efficient cash collection, and better liquidity performance throughout the period analyzed.
Moving on to the asset turnover ratio. This ratio measures how efficiently a company uses its assets to generate sales revenue. Based on the analysis from 2021 to 2025, Panasonic generally recorded a higher asset turnover ratio compared to Panasonic. Panasonic's ratio remained around 1.00 and above throughout most of the period, while Panasonic's ratio fluctuated between 0.92 and 1.08. This indicates that Panasonic was more efficient in utilizing its assets to generate sales revenue compared to Panasonic. Next, the debt to assets ratio measures the proportion of a company's assets that are financed through debt. Panasonic recorded debt to asset ratios ranging from 0.46 to 0.55, whereas Panasonic maintained significantly lower ratios ranging from 0.13 to 0.17. This suggests that Panasonic relied less on debt financing and therefore faced lower financial risk than Panasonic. The debt to equity ratio measures the relationship between total liabilities and shareholders' equity. The analysis shows that Panasonic recorded higher debt to equity ratios ranging from 0.85 to 1.22. In contrast, Panasonic consistently maintained lower ratios between 0.15 and 0.20, reflecting lower financial leverage and lower risk.
Next, for the time interest earned ratio, this ratio measures a company's ability to pay its interest expenses using operating profit. Based on the table, Panasonic consistently recorded much higher TIE ratios than Panasonic throughout the 5 years period, indicating a stronger ability to meet its interest obligation. In contrast, Panasonic TIE declined significantly from 6.17 in 2021 to 0.25 in 2025, and even became negative in 2024 due to operating losses. Overall, Panasonic demonstrated stronger financial stability and a lower risk of defaulting on interest payment. For the net profit margin, this ratio shows how much profit a company earned from its sales revenue. As shown in the graph, Panasonic maintained higher and consistently positive profit margin across all 5 years. Meanwhile, Panasonic experienced negative profit margin in 2023 and 2025, indicating net losses during those years. Therefore, Panasonic shows stronger profitability, better operational efficiency, and more consistent financial performance compared to Panasonic.
Return on asset or ROA measure how effectively a company uses its asset to generate profit. Based on the data, Panasonic recorded a higher ROA than Panasonic in most years, which indicates better efficiency in utilizing its assets. In 2021, Panasonic ROA was 11.97% compared to Panasonic 5.50%. Although Panasonic ROA dropped sharply to 0.56% in 2022, the company recovered strongly in the following years, reaching 8.69% in 2023 and 9.81% in 2024. In contrast, Panasonic showed fluctuating performance, with ROA declining to as low as 1.43% in 2023 and 1.23% in 2025, suggesting lower profitability relative to its asset base. Overall, Panasonic demonstrated better asset efficiency and profitability than Panasonic throughout the 5-year period. On equity or ROE measure how effectively a company uses shareholders' equity to generate profits. Based on the data, Panasonic generally achieved a higher ROE than Panasonic, indicating stronger return for its shareholders. In 2021, Panasonic recorded an ROE of 14.33% compared to Panasonic 11.92%. However, in 2022, Panasonic outperformed Panasonic with an ROE of 9.18%, while Panasonic ROE declined to 6.73%. This suggests that Panasonic was more effective in generating profits from shareholders' investment during that year. In 2023 and 2024, Panasonic regains its stronger position, recording ROEs of 10.08% and 11.39%, while Panasonic ROE dropped significantly in 2023 before recovering in 2024. Overall, Panasonic demonstrated better performance in generating return for shareholders over the 5-year period, despite some fluctuation in both companies' ROE
From this
value.
graph, we can see that Panasonic consistently record higher EPS value throughout the period. Although its EPS fluctuated, it remained positive every year, showing that the company was able to generate profit consistently. On the other hand, Panasonic showed a declining trend. Its EPS was positive in 2021 and 2022, but became negative from 2023 to 2025, indicating that the company experienced losses during this year. Overall, Panasonic demonstrates stronger profitable and more stable earnings, while Panasonic faces challenges in maintaining its financial performance. Panasonic maintained positive PE ratio throughout the 5 years, which indicate continued investor confidence in the company earnings and future growth. Although the ratio changed from year to year, it remained meaningful because the company was profitable. In contrast, Panasonic only had positive ratio in 2021 and 2022. From 2023 onwards, the company recorded losses caused the PE ratio to become not meaningful. Overall, Panasonic shows stronger market valuation in investor confidence, whereas Panasonic declined earnings reduced its attractiveness to investors.
For this section, I will discuss the trend analysis of financial ratio for Panasonic Holdings Berhad and Panasonic Manufacturing Malaysia Berhad from 2021 to 2025. Starting with liquidity, we use the current ratio and quick ratio to measure the ability of a company to meet its short-term obligation. For Panasonic, the current ratio increased slightly from 1.38 in 2031 to 1.52 in 2034. But then, it drops to 1.28 in 2025. A similar pattern is seen in the quick ratio, which fluctuates between 0.71 and 0.94 and remain below 1. This indicates that Panasonic has limited liquid assets and may struggle to fully cover its short-term liability without relying on inventory. In contrast, Panasonic shows a much stronger liquidity position. The current ratio remains consistently high, ranging from 4.21 to 5.32, while the quick ratio also stays strong between 3.62 and 4.92. This shows that Panasonic has more than enough liquid assets to cover its short-term obligation and maintains a very stable liquidity position. Next, for efficiency, we look at the asset turnover ratio, which measures how effectively a company uses its asset to generate revenue. Panasonic records higher asset turnover ratio, ranging from 1 to 1.21. Although there are slight fluctuations, this indicates that Panasonic is more efficient in generating sales from its assets. On the other hand, Panasonic has lower asset turnover ratio between 0.92 and 1.08, showing that it generates less sales per unit of asset compared to Panasonic. This suggests that Panasonic is more operational efficient in utilizing its asset. For solvency, we analyze the debt-to-asset ratio and debt-to-equity ratio to evaluate financial risk. For Panasonic, debt-to-asset ratio fluctuates between 0.46 and 0.55, indicating a moderate to high reliance on debt financing. The debt-to-equity ratio also shows stability, suggesting higher financial risk compared to Panasonic. In contrast, Panasonic maintains a very low debt-to-asset ratio between 0.13 and 0.17, which indicates low reliance on debt and strong financial stability. Although the debt-to-equity ratio values appear unusually high in some years, the overall trend of debt to assets clearly shows that Panasonic is less risky financially. Profitably, we analyze multiple indicators including ROA, ROE, net profit margin, EPS, and PE ratio for Panasonic. Profitably is unstable. ROE and ROE fluctuate significantly, with some years showing weak or negative performance. Net profit margin also declined in certain years, indicating inconsistent profitability. EPS and PE ratio are also highly volatile, reflecting unstable earning and investor confidence. In contrast, Panasonic shows more stable profitability overall. ROA and ROE remain positive throughout most years, with steady improvement in some periods. Net profit margin is consistently positive, and EPS shows relatively stable performance compared to Panasonic. This PE ratio also reflects more stable markets as well.
Hi, my name is Novadila binti Effendi, and today I'm going to talk about the financial strengths comparison between Panasonic and Panasonic. Okay, based on our financial ratio analysis, Panasonic appears to be financially stronger than Panasonic overall. First, in terms of liquidity, Panasonic demonstrates a stronger ability to meet its short-term obligations. The company consistently maintains a healthy liquidity positions, indicating that it has sufficient resources to manage its day-to-day operations and also commitments. Next, when looking at profitability, Panasonic shows stronger performance in generating returns from both its assets and shareholder investments. The company is able to produce profits more consistently, while Panasonic experiences greater fluctuations in financial performance. So overall, Panasonic performs better in most of the key financial ratio categories that we analyze, suggesting a stronger financial position compared to Panasonic. Based on the overall ratio analysis, Panasonic is considered the stronger financial candidate. The company demonstrates a stronger financial stability through its lower reliance on debt and its ability to maintain healthy financial performance throughout the period analyzed. Panasonic also performs better in profitability, indicating that it is more effective in generating returns from its assets and shareholders' investments. Although Panasonic shows better efficiency in utilizing its assets, this advantage is not enough to outweigh Panasonic's strengths in liquidity, solvency, and profitability. Therefore, our group concludes that Panasonic is the more financially attractive company overall. Thank you, and that's all
Hi,
from me.
my name is Nura Asha binti Sharizal. My matrix number is 165478. So apart from financial historical financial performance, our groups would also consider several factors before making an investment decision. The first factor is a financial ratio. What is a financial ratio? Financial ratio are a numerical measurement that helps to evaluate a company's financial performance. They are calculated using information from a financial statement and can show a company's profitability, liquidity, efficiency, and ability to manage them. In a financial ratio, the first factor is the industry and a market position. So this refers to how strong a company is compared to its competitors. So a company with a strong brand reputation will produce a loyal customer and a large market share, and is more likely to maintain its sales and remain competitive in the market. Next, the second factor is the economic environment. External factors such as inflation, interest rates, and the consumer purchasing power can affect a company's performance. When prices increases and the cost of living becomes higher, consumers may reduce their spending, which can lower demand for a certain product. Discussing about the importance of industry, market position, and economic condition, now we will look at the future growth prospect and risk factor, which are also important consideration in making an investment decision. Non-financial factors. So this is a qualitative factors that help investors to evaluate a company's future potential, risk, and a long-term sustainability beyond what is shown in the financial statement. The first factor is a risk factor. So we know every business will face risks that may affect its future performance. For example, supply chain distribution can increase costs and delay production. Second factor is a dividend policy. So what is a dividend policy? A dividend policy refers to how a company distributes its profit to its shareholders. A company that consistently pays a dividend may indicate a financial stability and strong cash flow. So for investors who seek a regular income from the investment, a stable dividend policy can be an attractive factor.
To wrap up our presentation, our group strongly recommends Panasonic Manufacturing Malaysia Berhad as the superior investment candidates. In today's volatile economic environment, Panasonic serves as the ultimate defensive choice. Its virtually debt-free balance sheet insulates it from interest rate hikes and keep its cash flows secure. In contrast, Panasonic faces cash pressures, high leverage, and ongoing net losses. Therefore, we conclude that Panasonic offers the most secure, resilient, and fundamentally sound option for long-term investor wealth preservation. Thank you for